how our banking and financial system changed real estate and also stocks forever, and what you need to know about coming bigger changes. So welcome to this highly unusual presentation. I wrote this presentation because I'm very concerned about the rather massive and rather oversized effect of central banking policy on real estate, on the stock market, and also on the bond market. And I don't think that it's just me who thinks that some of the actions that central banks are taking today are bizarre and have huge consequences. Hopefully, there are people watching this presentation who feel the same way. Now, even if you don't, you'll find this presentation to be very thought-provoking. So I'm going to skip past this since you already know who I am. By the way, I didn't get a chance to say this before, so I want to point out that this is the really boring stuff that my lawyer forces on you. We're not investment advisors. This is an educational webinar. It doesn't squeeze out the risk in real estate investing. My recommendations are not magic. These are personal opinions. Do your own due diligence, consult professionals, and understand that even if you do all of these, in this world, you could still lose money. Bottom line, real estate and stocks are at-risk investments. So, and you're the one taking that risk, not me, right? People like us take that risk on your behalf. All right, this presentation is split into 3 parts. The first part shows you a world that is drowning in growth-killing debt. And then in part 2, we talk about bizarre interest rates and how they're warping the world economy and really changing the world economy extremely radically. And then in the third part, we talk about outcomes. We talk about outcomes for you, outcomes for the average Joe American investors, and then we finish with 2 scenarios for real estate in 2020 and 2021. And we talk about how these scenarios are likely to affect real estate prices, and then we can do some Q&A. I mean, in fact, I don't mind you guys lobbing questions at me throughout this presentation. This is more of an economic presentation than a real estate presentation, though we are going to tie it back to real estate. So I might take a break or 2 to answer some of the questions as I go forward on this presentation. All right. Before I start, I'm going to say this. I'm going to share a ton of what sounds like bad news in the next hour, and it is bad news. But there's a silver lining there for risk investors like real estate investors and stock investors. So wait for the silver lining. It's near the end of my world-spanning story. Let's start our discussions with the question that is at the top of the page. What really drives the price of real estate and stocks? Is it the policies of Republicans and Democrats? Is it the jobs? Is it the economy? Is it the lack of new construction? Probably all of these, right? But for the moment, I want you to imagine a what if. What if all of these are smaller factors and there was an 800-pound gorilla in the room? Wouldn't it be interesting to learn more about this gorilla? What if, since 2001, the ever-increasing prices of real estate and stocks and Bitcoin are being driven by some shadowy people? These are the people who run the world's central banks. People who, in the immortal words of Obi-Wan Kenobi, have become more powerful than you can possibly imagine. Is there a person watching this presentation today that can name all 5 of these people? Everybody knows Trump. Everybody knows Biden. Who here knows all 5 names? Anyone? Come on, there's got to be somebody who knows all 5. These are people that are controlling your destiny. So from left to right, Alan Greenspan, Ben Bernanke, Janet Yellen, Mario Draghi, and Hirohito Kuroda. These are the 5 largest central banks in the world. Think about it. Who is it who controls all of your money? Not us, definitely, not us. The father of the mass automobile production, Henry Ford, once said, "It is well enough that the people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning." And perhaps the reason we have not had that revolution is because we, the people, have never bothered to understand the impact of our banking system on our wealth and on our well-being. So now, having said that, I'm going to make an even grander statement, bigger than the last one. Is it possible that since 2008, how the entire world economy performs depends on what the central bankers do? Is it possible that our civil servants have now become our masters? Think about it. We all know who the politicians are, but none of you, not one person in this name, could name these 5 people that are controlling your destiny. And if you think I'm exaggerating, I invite you to check out the sheer hubris, the sheer astonishing arrogance of this very public quote. Alan Greenspan, past Fed chairman, has publicly said this: "There is no other agency of government that can overrule actions that we take." This is public record, people. Not only do they have incredible power, they are well aware that there's no checks and balances system in place for anyone else to question that power. A bit scary, isn't it? Right? It is to me. I mean, so now with some of these questions in mind, we start our story. And to get the answers to these questions that I'm raising, we're going to dive deeper into a story. And it's a story that's going to tie back into real estate and to all the investors in this virtual room. The first part of this story is not about central bankers. It is about debt, way too much debt. The story begins in 2008. The time frame from 2008 to now, to the COVID crisis, are what we call the denial years. And the years to come are going to be the resolution that 1,000 economic books are going to be written about. So let's start with debt. Absolutely crushing, suffocating, growth-killing debt. The truth is that the world is drowning in debt. And this is debt that we cannot afford. We have now blown the mother of all bubbles. Our global debt is now at 255 trillion. That's trillion with a T. And by the way, with the coronavirus crisis, we expect that number to grow by an astonishing rate in 2020 and 2021. The truth, we are now playing the game of loans. And even the Khaleesi herself would be shocked by the outrageous risks that are being taken by politicians on our behalf without our permission. For instance, did you know that global debt is now 40% higher than it was just in 2008? And did you know that in 2019, global debt was a mind-boggling 322% of our global domestic product? We expect that number to cross 400% by the end of next year, thanks to our unfriendly neighborhood virus. Man, one interesting side benefit of the coronavirus crisis is that we are all learning about exponential graphs and how quickly numbers can rack up once we are in the vertical portion of a hockey stick. The chart on the left shows you how we went from having a very small amount of debt, $370 billion in debt in 1970, that's 50 years ago, to about $23 trillion today. So in 50 years, our debt has increased 63 times. 50 years, 63 times. If anyone else thinks that this is nuts, could you please say so in the chat box, people? Say so, right? I mean, because I think that this is absurd. Now, it's unquestioned that we are the most powerful and incredible country in the history of this world. But Houston, we have a very serious problem. Even before coronavirus, we were projected to have our national debt get over 100% of our GDP. And that's just government debt. We're not including household debt and the sort of debt that you and I owe, like mortgages and car loans, or the debt that businesses owe, or the debt that banks owe. And 2020 will have the largest deficit in history at $4 trillion or more. More if you do more rounds of the CARES Act. This makes the 2008 deficit seem puny by comparison at only $1 trillion, only $1 trillion. And if you think that this is bad news, I have a true shocker for you. If you think that our debt is a problem, then here's the absurd good news. We are so much better off than everyone else that our staggering debt load may not really matter. It may not matter. And to learn why it may not matter, let's look at other countries and their debt problems. And we're going to start off with China, the growth engine of this world. Well, it appears that the growth engine of the world was fueled by the single greatest debt orgy in the history of the world. In 2009, right here, China had $7 trillion in debt. In 2019, before the coronavirus crisis, China had $43 trillion in debt. So the debt went up 6x in just 10 years. And that was before coronavirus devastated the Chinese economy. Let's look at their debt to GDP ratio. Remember, our debt to GDP ratio before coronavirus was around 105%. In 2007, China was already over that at 165%. But by 2019, their debt to GDP ratio had skyrocketed to 304%. And they were able to make that work because they were growing 6 to 7% a year. But in Q1 of 2020, the Chinese economy shrank by nearly 7%. So how will they even pay the interest on their debt? It's fair to say that when you look at this pigsty, the US is a much better looking pig than the Chinese pig. And if you think that our real estate is expensive, you might want to look at China. Their real estate prices more than doubled, 107% between 2010 and 2019. In fact, they're up nearly 50% in just the last 4 years. And as you can see on the right, the growth is now cooling, which makes it easier for their massive real estate bubble to pop. In fact, here's a quote from John Malden, my favorite economist. John says, and I quote, "Depending on who you want to listen to, 30 to 80% of the last 6 trillion the Chinese borrowed went to pay interest on the debt they already had. In less polite circles, we'd call that a Ponzi scheme." So yes, the US is definitely the better looking pig in comparison. But that wasn't just China that went on a debt-fueled binge. The other 4 countries that are part of the BRICS acronym, Brazil, Russia, India, South Africa, all went nuts. In fact, in the 2005 and 2016 timeframe, these countries as a whole increased their debt by 500%. 500% in 11 years. And keep in mind that these economies are not like China. They usually only grow by 2 to 3% a year, right? So with that kind of growth, they increase their debt 500%. And now we come to the land of the rising debt, Japan. Fortune magazine couldn't be more blunt. Forget Greece. Japan is the world's real economic time bomb. And why is that? Well, let's look at their debt to GDP ratio. It's at a staggering 238%. Remember, for comparison, the US was around 105% of GDP before coronavirus, right? Now you might say, but Neal, China is above 300%. So isn't that Japanese pig looking better than the Chinese pig in our pigsty of countries? The answer is no. The Chinese economy grows by 7% a year, almost like clockwork. The Japanese economy struggles to grow at 1% per year. And while China has strong population growth, look at the bottom left graph. And you can see that here on the right, Japan has a shrinking population and it's an aging workforce. Both of these factors mean that Japan at 238% of GDP is far, far worse than China at 300% of debt to GDP. And what are the Japanese doing about it? Well, simply put, their central bank went in and they are now went all in, and they're now 7 years into the grandest, biggest, the most reckless monetary experiment in all of history. This experiment is called Abenomics, named after their Prime Minister Shinzo Abe. Simply put, Abenomics is about massive increases in government spending and massive increases in monetary stimulus, money printing, all designed to create inflation. So much debt that 50% of their total tax revenue already goes just to service this massive debt, 50%. And that was before the coronavirus hit that they've taken, right? Just staggering. And what are the Japanese, doing about this? I mean, if you want to consider this experiment reckless, I want to contrast this with what we did in 2008. They're doing the same thing, but they're doing it 3x larger than we did. Not 30% more, but 300% more. And we have a growing population, a growing economy. They have a shrinking economy and a shrinking population. And so this grand experiment to create inflation, did it actually work? Well, they started the experiment in 2013 with this massive sales hike. So you see this right here is a massive sales hike. And you see that it did spike inflation. So if you see inflation here is at 1%, 2%, 3%. So it briefly went up to 3%. Yay. And then after that, guess what happened? They needed 2.5%. Right here, you see this line here? That's the 2.5% line. They needed 2.5% for them to sustain this insane experiment. And at no point since early 2014 have they been anywhere close to 2.5%. In fact, there have been times when inflation has been negative, deflation. Not once since 2014 have they been anywhere close to their 2.5% goal. Not even 2%. They never crossed 2% in that time frame, right? And guess what? What do you think their response to this failure of creating inflation has been? Well, they're doubling down and spending even more. Which brings me to my favorite quote from a man you might know. Insanity is doing the same thing over and over again and expecting different results. Now you're looking at this and thinking, what the F, right? Imagine if you're a creditor. Imagine you're somebody like that's running a pension fund. What do, right? If you're rational and you're careful, then you might decide that lending to these countries is risky, right? So what should you as a lender do to reduce your risk? Well, it makes sense that you would increase interest rates to account for that risk, right? You'd move up the interest rates so your risk was mitigated. Or maybe you would stop lending altogether to all these people, right? Let's go into part 2 of our story and take a look at what is actually happening to those interest rates. And by the way, this is a great place to watch for hints on why real estate prices only seem to go up, even though they shouldn't be going up, they should be going down. Here's your hint, right? Let's take a look at it. So part 2 is interest rates. Insanity is prevailing yet again. So here's COVID-19, and you look at where interest rates were, and you look at what everyone has done. Here's our Fed, right? Cut interest rates by 2.25% to the zero-bound Bank of China, 1.5, Bank of England, 0.65. Actually, they've cut again after this graphic was taken. 30% of the developed world's government debt is now at negative interest rates, mostly held in the EU and Japan and now spreading to the US. You pay to lend money to the government. How insane is this? You pay to lend money to the government, right? And almost 100%, actually all of 100% is at zero or negative yield if you factor in inflation, because inflation is still there, right? So if your yield is 0.25%, it's not 0.25%, it's 0.25% minus the 2% of inflation. So that brings it to negative 1.75%. So why are people so nuts? Why are there trillions of bonds that are negative, right? You look at Spain, right? Spain, this crazy country that did all kinds of really horrible shit when it came to the real estate bubble in 2006, 2007. They had a massive debacle. Their unemployment rate went completely insane. And today, that Spain can borrow for 10 years at 0.373% interest rate. That's today, after coronavirus, by the way. And before Spain joined the European Union, their bonds yielded 14% on average. And by the way, remember that their unemployment rate is 14%. Our unemployment rate last month was 3.5. Theirs was 14% before coronavirus, right? And this is the best number they've had in the last 6 years. But for some reason, they can borrow 10-year bonds at 0.73%. Nuts. If they can borrow at 0%, let's keep the debt party going. Why would they ever stop? You look at Italy, another country that has been horrible with their fiscal management, absolutely horrible. Did you know that a month before coronavirus hit, there were more banks that were insolvent in Italy than there were in the United States in 2008, right? But Italy can borrow for 10 years at under 1.8%, right? And by the way, it was 0.9% in Jan 2020. So it's gone up from 0.9 to 1.8%. Their economy is collapsing. Their government debt is rising. Their national debt is now 131% of GDP. But hey, they can borrow at practically 0%, not quite zero, right? So let's keep the debt party going. Why would they ever stop? You've got a financial world that's really gone nuts, right? So negative government bonds are on the rise. 2014, almost no negative government bonds in the world, right? All governments had to pay to raise money. March 2015, 4 trillion. 2016, 7 trillion. 2017, 10 trillion. And then the economy improved worldwide a little bit. So after going up to 17 trillion, the number went down just a tad bit. and then hit 14 trillion. It started to rise again and hit 14 trillion before. Actually, this is March 2020, so it's pre-COVID-19. I expect this number now to be in the $20 trillion range by next year. Imagine this. This is your money. This is money that you lend to give to pension funds. This is money that you give to, whoever's managing your Social Security, or whoever's private corporations that are managing your pension. And guess what they do? They go out and buy bonds at zero or at negative. And as a result of this, it's time to coin a new term. And remember, you heard this here first, right? Subprime governments are now in existence, because this is the largest and the fastest growing bubble in all of history. Subprime governments spending like there's no tomorrow. This is why we always look like the best looking pig in the pigsty. Look at this. Welcome to the upside down. Those of you that watch the Stranger Things series know that there's a world called the upside down. But this is happening on our earth. Here's a Danish bank, their second largest bank, launching the world's first negative interest rate mortgage. Genski Bank will effectively pay borrowers 0.5% to take out a loan, right? I read this kind of stuff and I go, WTF? I hope you know what that means. I look at this and go, how is it possible in our world for a bank to pay borrowers money to take out a loan? But it's true. You can Google this article. It's on the web. So just completely bizarre sort of things are happening because of what the central banks are doing with interest rates, right? These things are not supposed to happen. But of course, you're thinking, yeah, but that's Denmark, the European zone, Japanese. These people don't know what the heck we're doing. We're the United States of America, and we are against negative interest rates. We would never have negative interest rates. And here's Janet Yellen saying publicly, if it were possible to take rates into negative territories, I would be voting for that. That is the chairwoman of the American Fed saying that if it was possible to take rates into negative territory, and that was pre-COVID, now of course everyone's saying it's okay, she would be voting for it. And you think that it's only the Fed that's voting for this? Here's our president. It bothers me when Germany and other countries are getting negative rates paid to borrow money, something I could get used to very quickly. Love that. Donald Trump, President of the United States. So it's a downward spiral. And why has this happened, right? Well, let's talk briefly about why it has happened. Why are these powerful federal bankers cutting rates? They've cut rates altogether around the world 650 times in the last, I think that was just the last 8 or 9 years. So it's now a higher number than this. That's one rate cut every 3 trading days since September 2008 when the crisis started. So you look at these, why are they cutting so often? And here I'm going to do what is known as a dogma alert, right? So those of you that know the stock market know that a dogma is this belief that has nothing to do with reality, but it's something that everybody believes. And because it's something that everybody believes, people keep doing it without actually measuring the impact of what they're doing. All the Federal Reserves of the United States have a belief, and that belief is that if you force yield down, it will push up asset prices higher and create growth. Now, all of you might immediately saying, wait a minute, that's true. Asset prices do go up when yields go down. We've already seen that in the last 9 years. The question is, can it keep going up? The Fed is simply looking at the last 9 years and saying, we are victorious, we did it. The question is, as you move those assets up, you deform and warp the system so badly that it creates that the potential for crashes becomes 10 or 100 times higher. Here's the other reason that the Federal Reserves of the world are cutting interest rates. And this is not dogma. This makes complete sense to me, but it's shocking, right? They force it down to finance the ever-growing debt. The United States is the best looking pig in our pigsty, but it cannot pay its debt at 5% either. It cannot pay its debt at 4%. I think we're okay at 3%, and we would really like to pay our debt at 2% or 1%. Right now, the 10-year Treasury is under 1%. So obviously, it's much easier for us to pile on debt if interest rates keep going down and down. Now, publicly, they always say that we want to take them back up. But of course, they have to say that because belief in the system is what allows them to keep decreasing the rates. As long as people believe that the rates will come back up, they'll be okay with the rates going lower and lower and lower. So the Fed always has to say what it does not intend. And as a result, what the Fed is doing is pouring gasoline on a fire. And that's why asset bubbles are being blown everywhere in the world. Stocks, bonds, real estate, Bitcoin, these are all bubbles because central bankers are putting gas on a fire. And let's question this. I mean, wasn't their end result, their end game to fuel growth? They want a higher level of growth. So when they threw these trillions and trillions of dollars out there and they cut interest rates to zero, did it increase growth? Because that's what they're really after, right? I mean, that has to be their end game. Well, guess what happened after 2009? Here's worldwide growth after 2009. It's going downwards. And with the COVID shock, obviously, we're going to go much, much worse than that. But this is what millennials call a WTF moment. When you look at this, and it's very clear to them for the last 6 or 7 years that global growth is going down, why do they keep doubling down and keep doing the same thing that they were doing before? You look at projections, these are post-COVID projections, and only India, China, and Indonesia actually have growing economies in the next year or in 2020. And even those, look at how anemic these numbers are. And then you look at every other country in the world, we're all negative growth. And guess what we did in the last month or two? We cut interest rates and we created even more debt, much more debt. And you look at, I'm going to skip past this particular graph. That brings me to updating my definition of insanity, right? Insanity is doing interest rate cuts over and over again and expecting different results. I wish Albert Einstein were here because he'd definitely agree with me. So what are the impacts of this, right? Problems caused by these real estate cuts, right? Here's a comment from Bank of America Merrill Lynch. Incited by the belief that every single interest rate in the world is heading to zero, the mountain of cash on the sidelines has induced fresh, irrational upside in government and corporate bonds, where people are willing to pay 0.7, 0.3, or even pay negative rates for government and corporate bonds. Here's more problems, right? This is the president of the Fed, John Williams, the president of the Reserve Bank of San Francisco, saying you're seeing extremely high asset valuations in real estate, commercial real estate. The stock market is very strong relative to fundamentals. Look at how cheeky these people are. That is a natural result from low interest rates. And that is one of the ways monetary policy affects the economy. So the Fed is accepting the fact that they're the ones blowing asset bubbles in real estate, commercial real estate, and the stock market. They are no longer even saying, no, we're not doing this. They're saying, yes, we are. So what are the top 11 unintended consequences of rate cuts, right? So I'm going to give you 11, and there were 10, but there was an 11th one that I had to shoehorn in there. And keep in mind that some of these obviously in a corona world change, and we'll talk about that in my next presentation. Real estate. So you're seeing high valuations for real estate, and you think the US real estate is high? Look at Sweden, Australia, Hong Kong, China, Canada, right? Look at UK. I mean, they've got high real estate. We're just okay. I mean, it's nowhere near as bad. But the stock market here, you've got very high stock market valuations in the US. Other stock markets didn't go up as much. Their real estate went up, but their stock markets didn't go up as much as ours did. But ours certainly has been on fire for the last 7 or 8 years. It also has done something that's very interesting and beneficial. The US has now reclaimed its place as the world's top safe haven because of these rate cuts, because we are the only ones that until 30 days ago, we're the only ones that were actually giving people interest on bonds. Because we were the only major country giving people interest on bonds, you know, the 10-year treasury was 2%, we became once again the safe haven of the world because the European zone, Japan, no one was giving interest on bonds. So we've now again become a safe haven. So that is a positive impact of this. Returns are going down. Worldwide investor yields are declining. Think about this. This is where real estate, a lot of people say real estate is overpriced. And I say, no, it's not. What you have to understand is this. Back in the 1980s, interest rates were as high as 18%, right? So super high, right? And back then, real estate has to provide higher returns to be competitive because obviously treasury bonds are going to be much cheaper, much less riskier than real estate. So real estate had to have this higher return, this delta, to justify anyone investing in real estate. And so people in real estate were making 20%, 22%. And then as those numbers came down further and further and further, now we've gotten to the point where risk-free investments, such as treasury bonds, today make just about 0 or maybe 1%. So as a result, it is not surprising that real estate returns have been declining from 20+% in the 1980s to maybe 9% today. But note this, the difference between 0% or let's say 1% on investing in treasury bonds and investing 9% in real estate is 8% of returns. That delta is now wider than it was 20 or 30 years ago. How can anyone say real estate is too expensive? So today, in today's world, you make on average, and this is the worldwide average, this is the US-wide average of all real estate, right? So it includes all assets of real estate. So you make 9% with real estate and you make 1% with bonds. So you make 8% more. That gap is wider than before. How can real estate be overpriced? And one other unintended consequence is that the US dollar is actually growing stronger. It was supposed to weaken and it hasn't, and it's likely to continue to grow stronger as we move forward because once again, we're the reserve currency of the world. Growth is slowing, we talked about that. There's irrational exuberance in every marketplace. People are paying crazy numbers. I'm looking at the exuberance of the stock market in the last month. The month of April was one of the best months ever from a percentage perspective for the stock market, which makes no sense. Best month ever in the middle of a pandemic? Well, it's irrational exuberance because money can be borrowed dirt cheap. Boeing, which is hit very hard, was able to raise $25 billion at much lower cost than they themselves said they would be able to. Here's the bad consequence, retirement. You look at pension funds worldwide, they're warning about the fact that they're going to be insolvent. You probably know this, but most pension funds are required to hold some of their assets in bonds. So when they hold those assets in bonds, that portion of their portfolio makes no money, nothing, zero, right? Or close to zero, or in some cases negative, because these bonds are now going negative. And so now they have to make up for it in the at-risk portion of their portfolio, which in the past used to be mostly stocks, right? So 20 years ago, real estate was about 5%, bonds were about 40%, and the stock market was about 55%. You know what it is today? Today, real estate has gone from 5% to 20%. Why has it gone up so much? That's because it's higher risk or seen to be higher risk than stocks, and therefore the returns are higher. And so those pension funds have now started buying apartment complexes. No pension fund in the world was buying apartment complexes 20 years ago, but today there's plenty of them buying apartment complexes. Some of them are starting to build apartment complexes because they can wait longer for their returns, and so they don't worry about the risk. So now more and more people are getting into real estate, including pension funds. Obviously, gold has seen a positive impact because there's a lot more fear in the market. Some parts of the world are now going into deflation. The US may go into deflation in the next few months as well because the price of everything is falling. The price of cars is falling. The price of airline tickets is falling. The price of anything related to tourism is falling. So now the world is staring at deflation, which is odd because what we are doing should create inflation, right? You're printing huge amounts of money. You're increasing your debt levels, you're injecting liquidity into the system, and you might say, this is going to cause hyperinflation, and you would be 100% right. But what we've seen since 2019 is that before you cause hyperinflation, you're going to cause deflation. Why? Because you slow growth when you print money. So at any point in the last 9 years, have you seen inflation? No. It's never really been above 2% for more than 3 months at a time. It's been too low. The Fed has been trying to pump up inflation, even though they're printing money. So it doesn't make sense. There should be a higher level of inflation. But what we've now learned in macroeconomics is when you print huge amounts of money, you slow down the economy. And when you slow the economy down, you reduce demand. When you reduce demand, it's very hard to have inflation. And in the long run, we all know, everyone in this room knows that we're going to create hyperinflation. And that's going to be phenomenally good for risk assets like real estate. But until we get to that point, we're actually at risk of deflation in the world, right? And then, of course, you've seen the interest rates. You know, the US at this point is effectively close to zero. And for those of you that might think that the Fed is going to stop here, the Fed is not going to stop. The harder months of this crisis are in front of us, not behind us. And as we start realizing that the US is going to become a 90% economy, I'll explain what that means. As we understand that it's going to become a 90% economy, the Fed is going to go further. They're going to get more and more aggressive. All right, we come to the end of this presentation. What does this mean for average Joe investors? I think you've already seen some of those things. Clearly, we're not making more real estate. There's a specific amount of land in the US that is investment grade, and we're not making any more of that. So as we start just printing this money and go nuts with it, in the future, there is going to be hyperinflation. But until that, let's look at what is the short-term, impact of that. But before that, I want to show you some of my projects. So here's a project that I feel is in the right place. It's in Mesa, Arizona. Mesa is now the fastest growing city in the world. St. George was in the US. It's the #1 metro for rent growth. I chase rent growth around the United States. You notice I invest in different places in the US. Its population growth is 3 times that of the US. And it is a top performer, not at the very top, but top performer for job growth as well. And as you can see, I pick a metro, but then within that metro, I rarely invest in the city itself. So these are accolades for Phoenix. These are accolades for Maricopa County, fastest growing county in the US, America's best employer. This has been the fastest growing large US city in the past, well, actually 3 years in a row. But Phoenix is too expensive. So what I do is I look at that outstanding metro and I say, this is too expensive. Let me see what suburb of this metro is doing better than other places. And then I start looking at those areas. So I look at, rent growth numbers that are phenomenally high. Typically, we look for 2 to 3% of rent, but take a look at the Phoenix metro and how much higher it is than the national average. The national average is 2.6%, and Phoenix is at 6.9%. For Class C, or renter by necessity, the national average is 3.4, Phoenix is at 9%. So I look at these metros and then I build world-class products in areas where supply is so much lower than the demand. And then I build, an appropriate level of amenities. Obviously, we're making changes to our amenities in a post-coronavirus world. As you can imagine, some of these amenities are going to end up getting cut. Anyway, back to part 3. What does this mean for average Joe investor? Let's speculate. So the impact of central bank meddling on real estate, I believe that this is a horrible, horrible mistake. It's going to inevitably lead to a global market crash. And the point is, my opinion doesn't matter. What matters is what the reserve banks of the world think, and they're set. They're set on this path of lowering interest rates, debasing currencies, and as a real estate investor, you have no control over this. So you might as well use the opportunity to make money in the long run, at the expense of savers, because anyone who's a saver today is going to be punished by these people. When I look at their impact, they never learn. I am not seeing them learn post-COVID either, right? So my belief is that the real estate party is not only going to continue to grow, but it's going to get more boisterous. If you think it can't, well, look at what's going on in Canada. Look at what's going on in London. Look at what's going on in other expensive places. Singapore, their real estate is 3 times as expensive as ours because you've now got 0% interest rates. And there's this unending quests by pension funds for yield. They need profit, they need money, and that's driving them into real estate. So the other thing is that it will lower world expectation. People will be okay with a lower yield, right? So if bonds are at 0% and real estate is expensive and so are stocks, everyone will just adjust their viewpoint to making less money. So here's two possible scenarios on what 2020 and 2021 could look like. As you can imagine, each year when I do this presentation, it doesn't look this gloomy, but obviously this one's a fairly gloomy short-term outlook. This is the Fed scenario. So the Federal Reserve of the United States, they believe that this is what's going to happen. Recession in 2020, recovery in 2021. So they believe that we'll have negative growth somewhere around 4 to 6% this year, but that the US economy will bounce back from recession by Q4 of this year. There'll be no major shocks in their belief, which means that there are no currency shocks or major bankruptcies or countries in the world that become completely insolvent and go into a spiral. They don't believe that's going to happen. They believe that there's going to be less jobs, so they think that unemployment is going to stay at around 10% for the rest of this year, and then it's going to start reducing in 2021. They believe that interest rates will stay at the zero bound or lower in 2020 and 2021. They don't think that they're going to have to cut interest rates more. They believe that the stock market's going to stay in that 25,000 point bound, go up a little, go down a little, but be fairly stable. I mean, that's a relative word. Obviously, it's not been very stable. But when you look at these numbers, this is what the Fed believes. Inflation, they believe it's going to be well under control. They don't think we're going to have hyperinflation. They think it's going to stay around 1 to 2%. They think wages are going to stay flat or maybe decrease slightly. And so that's their belief. This is kind of the Fed's scenario, right? And a lot of people believe this because the Fed is the most powerful force in the US. It's not the politicians, it's not Congress, it's the Federal Reserve. And you've learned that by now. This is the other scenario. And really it's up to you as to what you believe. And, in my mind, in the Fed scenario, real estate's pretty good, actually. You're going to see some real estate price declines in this scenario, most likely in Q4. Right now, it's too soon. Real estate prices lag the economy. So there's likely declines of maybe 5 to 15% in prices. The stimulus is going to prevent the prices from falling further. The zero interest rates will prevent it. And prices will recover to almost, not quite, but almost the Feb 2020 level by Q2 next year. And because of ultra low interest rates and easy lending, prices are going to rise from there for 2 to 3 years. All right, here's the other scenario. Once again, it's about your belief. In this scenario, there's a worldwide depression that starts this month or last month. There's massive structural problems in the EU, in China, and Japan. They're going to push the US into a very, very deep recession. The US will continue to cut rates. Everyone else will continue to cut rates and will go very deeply negative. So you might see -2, -3, -4% negative rates. You might see unemployment rise in the US to 20 to 30%, which is what Spain saw after 2008, which is what Greece saw. So we might see something similar to that. You might see deflation in the economy. Greece wrestled with deflation in their economy for about 3 or 4 years. The US deficit could rise to over $4 trillion every year, not just in 2020, but in every single year. And you might see worldwide quantitative easing. At this point, in this scenario, you would see an absolutely astonishing amount of money being spent by governments in worldwide. I mean, we could see as much as $50 trillion injected into the world economy in the next 2 years. My belief is we might end up somewhere in the middle of these two scenarios. Now, in this scenario, the short-term outlook for real estate is horrible, short-term, right? So very negative in the short term. Unemployment goes up, rents go down. Home pricing will go down 20 to 50%. It's really hard to tell. Vacancy rates will go up. Cap rates will go up. But not too much because you have these lower mortgage rates. Flips are going to be super risky in this particular scenario. But this is short term, and by short term, I mean the next 24 months. This is what happens after 2 years. It's very positive. It's insanely positive because when you survive this crazy 24-month period, you should be able to benefit incredibly from the negative interest rates. I think that we could see real estate cap rates in the 2 cap or 3 cap range because interest rates are going to be -2 or -3 and will stay there for a very long time because the world takes time to recover from this recession. So I expect interest rates to be -2 or -3 in this scenario for at least 5 years. During that time, people will be making money in real estate, so you can see incredible prices. And at some point, you see hyperinflation. So when we see hyperinflation, you'll have trouble with real estate, but your assets will double or triple in their value every single year. So I do think that this creates another cycle of price inflation in every kind of hard assets. Gold will be worth more, real estate will be worth more, because one thing I've seen is the federal banks of the world are likely to pretend and extend, then that's going to be super bullish for real estate and probably for stocks. I'm going to finish off with a word that the world doesn't know yet, but it's going to become a very important word for us: debt jubilee. This is beyond the scope of this presentation, but you're going to start seeing this word more and more as this year goes on. More and more countries will start talking about, let's meet together and talk about a debt jubilee. A debt jubilee is an organized worldwide forgiveness of rent. If it happens, it's massively good news for real estate and gold and Bitcoin. Not sure about the stock markets, but a debt jubilee would be incredibly beneficial for real estate. And I think we're getting closer to the debt jubilee. Anyone here that's in this room that knows what a debt jubilee is, and have you thought about that? This is time for Q&A. We'll take your questions, and I'll give you guys a 10-minute break. I know, it kind of is unbelievable, isn't it? But the math, the numbers, they are what they are. So I think that we have to make our bets. There are no safe places in the world today. We just have to make our bets and understand what's happening. And we're in real estate, we're making our bets because we know that it's very difficult to get more real estate now. I don't know of any major city in the United States that has built a new ring of freeways in the last 20 years. We seem to spend all of our money just maintaining freeways. If you don't create new freeways, how are you going to bring new people in? How are you going to create new land? How are you going to create new, places to build? We're building 1/3 of the houses today in California that we were building in the 80s, but we don't have 1/3 the population growth. So it's becoming increasingly harder. Didi says, are you implying that we should wait to buy rental property because prices may go down in Q4? Yes, that's my opinion, Didi. Yes. So I think around Q4, you might see a significant decline, correct? And it may be fairly short term. Obviously, everyone on this call knows it's all about the vaccine, right? Availability of vaccine is the big X factor that controls everything.